banks will fail. I'm your host, Steve Van Metre, and thanks for joining me today. And Wall Street is warning that this will be worse than the subprime crisis. Let's go to Bloomberg, where we picked today's story up with a headline: Wall Street warns of trouble brewing in auto loans as prices dip. Red flags are showing up at Wells Fargo, Ally, and Fifth Thirds, even though they still feel really good about new loans, but probably not for long. Wells Fargo said that higher loan loss rates for loans that originated late last year contributed to an increase in write-offs for the period. Ally Financial, the country's second largest auto lender, saw charge-offs for retail auto loans quadruple in the third quarter. And Fifth Third said it's pulling back on originations. So what I want you to see here, as people enter delinquency and default on their loans, what do you see the banks reacting and doing? Originating less loans. Hold on to that thought. Used car prices slumped 7% in the third quarter, the worst decline since the depths of the global financial crisis, according to the data by Manheim. The risk investors fear is that if consumers end up owing more than their cars are worth, they might stop making payments and let the vehicles be repossessed. And this is something that we can go back to the great financial crisis itself. And what did we learn? What did consumers learn? That, hey, if you don't pay on your home, it's okay. You might actually be able to stay in it for a few years. And then once that gets cleaned up on your credit, after that, a little bit while later, you could go out and buy another home and not worry. And the people will see the same thing happening in the car market, but there's one big difference here. What we note is that people, when they bought cars, were rolling their equity, their negative equity, into their new loans. So in this case, they actually probably owe a lot more than the car is worth, making it even easier to make that decision to turn the keys back into the banks. When Wells Fargo first started to see signs of higher loan loss on its loans that originated last year, could you get that, just last year, the firm moved fast to tighten underwriting standards. The changes, combined with the impact continued supply chain constraints, caused auto loan origination volumes to plummet 40% in the third quarter from a year earlier. So you see that banks really aren't that good at this, in a sense that they react as well to changes in consumer trends. So when they start to see their loan losses rise, they start to react with, hey, we're just going to issue fewer loans. And of course, you start to see the credit cycle go from boom to bust. And we know that always happens when banks start tightening lending standards. Used car prices jumped during the early days of COVID-19, forcing borrowers who bought then to pay more. Not only that, as I mentioned, they took out bigger loans by rolling their negative equity into their new cars. Those customers are now reevaluating whether it's worth remaining current on their payments, something that could prove challenging for the auto finance sector going forward. And it's not just challenging. You think about, people often ask, like, Steve, do you think banks will fail? And the answer is, I do. And they want to know which ones. Well, think about this. What banks are out there originating volumes of car loans? Well, you tend to see a heavy reliance on smaller banks, credit unions, community banks, local banks, and they issue a lot of car loans, and you start to see them go bust. The problem is for them is they're going to get cars back that they're actually not going to be able to sell for a profit, because used car prices will be plummeting faster, and these cars they're going to get back are going to have big loan balances on them due to the fact that these banks issued negative amortized loans. Bonds backed by car loans are selling at the fastest pace in years, despite the fact that prices on cars are following. Auto asset-backed security issuance jumped 20% year on year, and car price rise boosts the collateral value on the short-term debt, but not for long. Asset-backed securities can get clobbered during an economic downturn as consumers get laid off and default on their debt. Is finally someone who understands it. During the financial crisis, the securities got hit particularly hard as a housing bubble popped, and bonds tied to the debt, including second mortgages and home equity loans, headed south. And so here you see again kind of what we didn't learn from the great financial crisis. What did we do with home loans? We took good loans, packaged them with bad loans, and says, don't worry, if some of these go bad, well, there's plenty of good loans in here. Well, guess what? Some of these loan originators did the same thing. They took what they perceive as good loans and bundled them with loans they knew were bad and sold them off to investors. And you can imagine somewhere along the line, something bad will come out of that too. And there are early signs that risk is creeping higher for the bonds as delinquencies edge higher in February from the same month last year, according to S&P Global. Subprime borrowers could increasingly struggle to make their payments in the coming months as they deal with the highest inflation in 40 years. And this makes perfect sense because there is a point where inflation is worse and growing faster than people's wages. And there are times where people, many of households have been in this situation, and maybe you have too, where you've had to pick between paying a bill and putting food on the table for your family. And ultimately, when people look and say, hey, I'm upside down on this loan, I'm never going to catch up, they're more likely to say, hey, you know what? Let them have that car back. I'll drive it till they figure it out. And for the banks, I'll tell you, they don't want these cars back. And when they get them back, it's going to hurt them, their bottom line, in a big way, because they'll have to take a loss to sell the cars. These risks seem manageable to many analysts and investors, in part because many consumers still have pandemic savings to dip if they have to. Of course, we've been hearing about that, and yet still no sign they're dipping into it. And bonds, of course, have ample protections for investors. We heard that during the housing market too. The market's not crashing, it's normalizing. We'll see. But what is the likeliness we're going to see unemployment claims rise? Well, we've got the 4-week moving average of initial claims in blue overlaid against the Wilshire 5000, the total U.S. stock market in red. And you might notice there's a fairly mirror relationship between these. So let's do this. Let's invert the Wilshire 5000. And we note in periods when we see the red line here rising, that means the stock market's going down. Again, it's inverted. We see initial claims rising. So what should we start to see here in the weeks and perhaps months coming forward? If we should see a rise in initial claims. And yet Cathie Wood's also ringing the bell that the subprime auto crisis is perhaps bigger than most think. Cathie Wood seeks risks for auto debt if car prices fall. Her comments follows a series of tweets. She said that the Federal Reserve is making a mistake with its interest rate increases and turning inflation into deflation. She notes if residual auto values deteriorate accordingly, the $1 trillion, get that trillion, in U.S. auto debt will be in harm's way. Autos were the best credit in 2008 and 9 as individuals prioritized their auto loan payments at the expense of mortgages so they could get to work and stay employed, something that they may not do this time around. And are there signs, of course, that we're going to see a recession? Yes, in a big way. Most in the NABE survey said the U.S. is already in a recession, or maybe soon. The National Association for Business Economics survey showed over half the respondents view a recession as more probable than not, while another 11% indicated the economy is already in one. The survey of 55 members conducted in early October indicated slower demand, get that, in easing in labor market tightness and a slight moderation in price pressures, as the share of respondents reporting higher sales exceeded the percentage reporting decline by just 8 points, the smallest differential since mid-2020. So what we're seeing is sales slowing down, and that is a key point. Let's go to the next part of this article, because some 33% reported higher employment at their firms. So we still see they're hiring over the past 3 months, but it's down from 38%. So the pace of employment is slowing. And get this, hiring plans also ease, with only 22% of respondents expecting to increase headcount in the next 3 months, down from 50% at the start of the year. So it starts with slower sales, and then it leads to less hiring. And you can guess what the next one is? If you thought it means wages, you got it. While nearly 2/3 of respondents said wages rose at their firms over the past 3 months, wage cost expectations for the coming months dropped significantly and now match the lowest reading since April 2021. As far as inflation, an index of materials costs fell 24 percentage points from a record reading the previous survey, as the outlook for costs also declined, and a smaller share of those surveyed expect an increase in prices their firm charge in the coming months. So what we're seeing now is that consumers are struggling to make their car payments. They need an increase in wages. And what did we just hear from that survey? That the likeliness of wage increases is going away quickly because sales are falling, and that means unemployment is going to go down, layoffs will start to come, and you can forget about getting a raise. And are there even broader signs the global economy is slowing down? Well, there are. We got some preliminary survey data today. Here we can see the preliminary manufacturing PMI out of Australia going to last night. Notably, it's an expansion over 50. 50 is unchanged. Below 50 is a contraction. So what do we know for Australia's manufacturing sector? Expanding at a slightly slower rate than last month. How about their services sector? Pretty much unchanged at 49. Heading over to Japan, manufacturing sector unchanged at 50.7. No change in the rate of growth. How about the services sector? Expanded just as much faster rate at 53. Now let's move into the Eurozone. Look at France. Their manufacturing PMI contracted at the same rate, so it's continuing to contract. How about their services sector? Well, it expanded at a slower rate. Head over to Germany, contracting at a faster rate in their composite. That means also their manufacturing base is contracting at a faster rate, as too is their services PMI, only a slightly faster rate, but not much. How about the broad Eurozone? Manufacturing contracting at a faster rate, services sector contracting at a slightly faster rate, or slightly faster rate. Having up to Great Britain, what do we know? The manufacturing sector contracting at a faster rate, as too is the services sector. And not to be left out, we head over to the U.S. How about the manufacturing sector? Now unchanged from the prior month at 49.9. How about the services sector contracting at a slightly faster rate than the before, indicating exactly what we know is this auto loan issue is going to blow up big when consumers can't afford their payments, send those keys back to the banks, and the banks find out they're upside down. Could be the beginning of the next financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.